Our chart of the day is coming from one of the most bearish voices on Wall Street. Morgan Stanley's Mike Wilson pointing out that the rally in the S&P 500 has been driven by only a handful of stocks, putting the index at risk of fresh lows if bond yields rise. The percentage of stocks outperforming the S&P 500 on a 3-month rolling basis is the lowest on record. Wilson pointing out that this is the market's way of warning us we are far from out of the woods with this bear market. Brad, interesting note by Mike. Monday mornings always start usually with a very bearish Mike Wilson note. So this is certainly right in his wheelhouse. He is saying this at the top of his report. It says, with the fastest Fed policy shift in 40 years, we think more negative surprises lie ahead for investors. And I think Mike is trying to say investors are not prepared correctly if earnings over the next few weeks really disappoint. Now, we didn't see that disappointment in the banks, but as we get some more non-bank companies, maybe those earnings results disappoint, guidance disappoints, and that wallops the market. Yeah,
the interesting thing here, and is something that I brought up earlier, is what the Fed, in terms of kind of an input into this broader calculus for the stock market, is right now. And it could be a little bit more muted than typically as we kick off this earnings season, considering that they're not going to have any more employment data that really comes forward, at least on the monthly BLS jobs report data, prior to their next meeting. So they're going to be looking at a couple months back. Let's remember, it's a mid-month reading to another mid-month. And so even for the data that they saw as of the beginning of April, that was still looking at mid-February to mid-March. And so with that in mind, I think even if you did have more of a muted Fed on the employment situation front and the market's trying to price in what and how that data could move the Fed's opinion, you kind of take that out of the equation. And then that gets you into this other thought that Mike brings up. If there's one thing that can throw cold water on the large mega cap rally, it's higher yields due to a Fed that can't stop hiking as soon as perhaps some investors are expecting here. And so the Fed is really one of those, it always has been, of course, but specifically within the kicking off of some of the tech conversation, that's where it's going to be even more outsized of a consideration, or should be, as to whether or not any concerted move higher is triggered by tech in this instance. And so it'll be interesting to see where some of the kind of macroeconomic conditions that CEOs, including and especially within tech, cite over this earnings period.
What I do think Mike might be underestimating here is the degree of cutbacks and layoffs in tech. And really, I would argue these quarterly results, that first quarter, is really going to be that first quarter where I think investors get a sense of how much margins are benefiting from a lot of these layoffs. And to that end, 90% of S&P 500 companies that have reported earnings so far, of course, very earlier in the season, they have beaten. So it has been a good start to earnings season. But again, whether that continues, it's anyone's guess.
All right, well, earnings season certainly kicking off here over the past week, and we're going to get more of those big names coming over the course of this week as we were breaking down earlier.